You can make a lot of money buying and selling puts, but at the end of the day, puts, calls, and investing in general, it's just a game of chance. So that's why in this video, we're going to talk about 3 of the different ways that you can increase your chances of earning a higher return through puts. If you guys enjoyed this video, make sure you subscribe to Beat the Market, where we talk about investing here very often, actually all the time. So the first thing you do to increase your return with puts is to sell cash secured puts. Pretty much instead of, and the other two will talk about buying, but you sell a put instead of buy it. So you get the premium. So instead of you buying a put and you paying to buy that put, you sell a put and then someone pays you for the right to buy the put from you. And you are obligated, if you sell a put, to buy a stock at a certain strike price if it hits that strike price or goes below it before expiration. So I only recommend selling puts for stocks that you would have no problem earning, and there's no chance, or at least there's a significantly low chance of them tanking within the next few weeks. And it could be 1 week, 2 weeks, a month, depending on how far out the put is that you sell. The second way to make additional money through puts is to buy them with longer expirations. So while it costs less money to buy a put that expires within a few days instead of a few weeks, it significantly increases your risk. So for instance, that a company, it is going to go up or it's going to go down. There's a lot of catalysts supporting one of those directions. Now, just because you see all these different catalysts or these different headwinds doesn't necessarily mean they can play out within your selected time frame. So you could pick a stock that has all these different good things going for it, but if you buy a put or a call, in this case, since you've got catalysts, that expires in a few days and the stock stays flat, sure, the long-term narrative may be there, but you need it to be right in the short term for you to make all this extra money with your puts. So if you see a lot of the headwinds, if you see a lot of reasons for a stock that is likely to go down, buying a put further out, like 2 weeks out, 3 weeks out, 4 weeks out, even more than that, part of it does depend on the premiums, because you don't want to buy a put where the premiums are super high and don't offer as much of a chance for a high return. You put yourself in a scenario where you have more time for the stock to move in the direction that you want it to. In the case of buying a put, you want the stock price to go down. So just being careful about the expiration and also picking a put that is near the money. If you pick one of these out of the money puts that's really far out, then it's only going to work if there is significant movement to the stock price within your selected time frame. And these are very risky investments, especially the ones far out of the money, because when the put expires, it's absolutely worthless. So there is a chance, or very quickly, based on expiration, by the time it hits expiration, any amount you put into buying puts could turn into zero. So if you stay near the money, it increases your chances of the put increasing in value and not becoming worthless. And since you pick an expiration date further out, you can weather if the stock moves up in like 1 to 2 days, and then you still have some time for it to go down at a point where you profit from the put. The third strategy is one that doesn't receive as much attention. It's knowing when to cash out and cashing out strategically. So you could have a put that doubles, triples, quadruples, even more than that in a single day. And that is a great time to get out, because what happens is you get this massive gain, and then all it takes is the stock price to move up in the same way it moved down. And if you have a big drop in the stock price, it's very volatile at that moment. So it could just as easily shoot up in plenty of cases, because when some people, they see a stock is down 20%, they think, oh, buying opportunity. So there's a lot of volatility in those moments. But at the same time, you may be in a position where I don't want to sell this put. I feel like the stock has more room to go down. So if you do find yourself in a position where when you bought it, it was near the money and now it is deep in the money, what you could do is sell this put and then immediately buy another put that is either slightly in the money or slightly out of the money. And with this in mind, not only do you lock in the gains from the previous put, but you also buy a put that puts you in a position where if the stock continues to go down, you will make very similar gains with this new put you bought versus holding on to the other put you had. And this strategy allows you to lock in the gains from the previous put. So you risk less capital, but you do put yourself in a position to make very similar, if not virtually identical returns if you do decide to buy another put that happens to be deep in the money, but not as deep as the put that you previously selected. So those are some of the different strategies you could use to make more money with puts. I'd love to hear from you guys. If you are buying any puts, what stocks you guys are looking at. I always love to engage with you guys in the comments. And I look forward to seeing you guys next time.